One of the hottest topics in Canada today is the amount of fees that the financial industry is forcing upon investors and people seeking good quality professional financial advice. So what we wanted to do today is spin this a little bit on its head and talk about what you should not be paying an advisor for. Number one is you should not be paying your advisor to simply sell you investment products. You must expect a full comprehensive financial plan, holistic financial planning, including tax advisory, insurance advisory, estate planning, including the aforementioned investment management. Too many institutions are simply selling proprietary products and not providing full suite of financial advisory that every Canadian deserves. Number two, you should not be paying your financial advisor to simply mail you statements. If you do not receive content and advice or tips or any type of communication on a more consistent basis, I would say even weekly, let alone quarterly, then you are missing out. You have to expect a greater level of communication and advice from your advisory team, and that could be in the form of technology. We send out a weekly email with different topics and advice in small, easy to consume forms so that at least our clients can stay fully aware of all the changes that are happening in the Canadian marketplace, but not simply just mailing out statements. That's unacceptable. And number three, we have to stop overpaying for underperformance. Year after year after year, the stats don't lie. Over 95% of all investment managers and portfolio managers underperform the market, and yet they're charging sizable fees, somewhere up in the nature of 2.5%, sometimes 3%, which is appalling. If you are at least not matching the performance of the market with either less risk or a better opportunity for potential return, then you're completely missing the boat. You have to expect the return on your investment is going to be justified by the fee that you pay. And too often, whether it be mutual fund managers or portfolio managers that have proprietary pressures and conflict, simply are not cutting the mustard. So now there's different levels of assets that warrant different types of fees and different advice, different types of client situations, family dynamics, etc. But for an example, if you are investing $500,000 to $750,000, you should never be paying more than 1 to 1.25%. And that's for the full suite of financial planning. If you are paying your advisor more than that amount, you better be justified with a higher than average rate of return. Secondly, a full financial plan, including accounting and tax advisory. And third, you better have amazing communication from your advisory team throughout the year, not just getting mailed statements. However, even if all those three things are apparent, you should not be paying more than 1 to 1.25% at about that $500,000 level.